please like, comment, and subscribe. Welcome back. We're about to get into a very important topic. This topic is so important that if you miss it, you will literally change the trajectory of your trading journey drastically. When I first got into trading, one thing that I realized is the stuff that seemed simple was something that I ran from because I thought that there was more to be learned. But I'm going to sit and tell you this right now. These two market conditions are going to be one of the most important things you learn in trading. If you can hone in on what's happening in these two market conditions, you will find true success in trading. For a while, I struggled with just understanding that the simple approach to trading is the key. I always thought there was more to be learned. But when I sat back and focused on things like this, it literally changed the trajectory of my trading journey, and it catapulted me into my success as a day trader. So let me show you the two strongest market conditions and how you can use them in your trading every single day. So first, we're going to talk about high resistance liquidity runs. As you can see here to the right, this is what we have here, right? A high resistance liquidity run is essentially a condition in the market where price struggle to get from one point to the next. These markets usually happen in seek and destroy days. For those who's ICT traders or SMC traders, these are conditions where price struggle to get from one point to the next. And these are not good conditions to trade in. As you can see, we have it marked here. These are bad conditions to trade in. I bet you my whole bank account that your worst trade setups was taken in a high resistance liquidity condition. Now to the right here, we have a low resistance liquidity run. This is the ideal conditions to trade in, right? It's proper institutional order flow. It's when institutional sponsorship working in our favor, order blocks, fair value gaps are being respected. And I also bet that during this particular moment, you've made most of your money. Your best trade setups probably came in this type of condition. So let's continue so I can show you some live examples. So here's more information about the high resistance liquidity run. This is a more detailed info. Here's more information about high resistance liquidity runs. Here's more information about high resistance liquidity runs. This is the key signatures. So essentially what you're looking for is overlapping candles, frequent retracements, fake moves, multiple liquidity grabs, order blocks, and fair value gaps being disrespected. That's key right there, guys. Price move with hesitation, chop, and in confusion, right? So what it really means is the market itself is in a state of balance. When the market is in balance, it is not the best condition for us to trade, because we both know that if something's imbalanced, that means there's no true reason to be delivered from one phase to the next. So in a balanced market is usually when you start to see high resistance liquidity being formed. So essentially, we want to take advantage of these trade setups only in an imbalanced state, right? And when the market is imbalanced, and I'm going to show you how that look on the chart. So at the very bottom line, you see the best response. As you can see here, I have it written here so you can understand the call to action during this time period. The smartest play here is patience. Wait for the market to manipulate out of balance, usually through a liquidity sweep. Then watch for clear signs of directional bias, displacement, and institutional delivery before engaging. So let me show you how that looked like on the chart. Here's a live trade setup that me and the community took. I forgot what day this was. It was like a couple weeks ago. And one thing that we realized, as you can see, here's a illustration of the high resistance liquidity run, and here's the actual live entry. You can see that we entered here, and then we realized that the market came back, took us out at the very bottom. We ended up closing out the trade setup. We took 1L for that day, but that 1L that we took was a good loss because we understood that we was in a high resistance, a high resistance liquidity run environment. So at the end of the day, that we kind of made sure that we didn't recommit into another trade setup. So we'll end up with 2 losses. We took that 1 loss and we kept moving. So to the left here, you have the 1 minute chart, and to the right, you got the 5 minute. So we entered there, and as you can see, we was taken out, and then we didn't get back in. And as you can see, it's a perfect illustration of what a high resistance liquidity run looks like. As you can see, the signatures and price that we talked about, the violation of fair value gaps, right? So there was a fair value gap formed here, it was violated. Also, the liquidity sweeps aren't really defined, meaning when this pulled liquidity, it did not surge bullish at all. It just came back in and played inside the range. Also, this was a liquidity pull here, came back and played inside the range. There's deep retracements, guys. That's key. Deep retracements after the range creation took out the range that was created. And you can see here there was a pullback in price, and price still was stagnant all the way into the next following day. But essentially, this is what a higher resistance liquidity run environment looks like. And what you do in this scenario is this: you box out the whole area, right? And you wait for price to go into the next day for manipulation, as you can see here, and you then take advantage of the move. Now, based off institutional order flow or whatever bias that you have, of course, you have to trade in the direction of that bias. But this is how you deal with situations like this. You allow price to accumulate, collect all the stops from the novice traders, right? The beginners and people who is just overly anxious to get inside these trade setups. I can tell you right now, maybe some people have lost 3 times. The professional trader only lost once, right? We only took 1 L that day. That's a good L because the fact that we understood that price was not healthy. We played the market because we seen that it was opportunity, and we got out of the market immediately when we realized that it was not a good market to be in. That's true trading. So as you can see here, the call to action will be you wait for price to accumulate. You then wait until the next following session where you see manipulation. And I'm talking about only London and New York session. We're talking about Forex and futures. And you wait for that manipulation to happen. You then engage into a trade setup after the fact. You do not try to engage during the accumulation phase of these trade setups, which is what we call the high resistance liquidity run areas. So this is essentially what high resistance liquidity looks like. So I'm going to show you an example of what low resistance liquidity look like. Let's take a closer look at low resistance liquidity. This is just as important as high resistance liquidity. And you ask why, right? The main reason why is because this is the healthy market condition. This is when we come to the market and we ball out, right? We make the most money. We have winning streaks. Everybody's making money during this time because price action is easy to read. For one, you can come to the charts and you can literally see fair value gaps being respected. A key is the fair value gap only trade maybe into the tip of that fair value gap or 50%. It don't even feel the fair value gap, and it continues to deliver from one point to the next. So this is really the best time to get inside the market. This is, I bet your best trade setups came from these particular moves, right? So as you can see here, you see institutional order flow going in the bullish direction. It is showing that sponsorship will be respected, and you can continue to keep going. As you can see, that liquidity high is being rated. So this is exactly what low resistance liquidity looks like, which is a healthy market. So in this type of condition, you should be looking for spaced out candles, right? Strong movement, minimal retracement. Fair value gaps and order blocks are respected and are often untouched, meaning that institutional sponsorship is holding up. Those fair value gaps and order blocks are holding price. They're holding price. That means you are in a good condition. What it means, the market is in an imbalanced state, right? This is an imbalanced state. This is when the market is reaching to balance itself out. Because when it creates an imbalance, it has to then balance itself out. And when it creates a balance, then it has to become imbalanced eventually. So this is how the market moves. This is how the algorithm moves. Just like nature, right? Nature. When there's an up, there's a down. There's a left, there's a right, right? So there's no different. When there's a balance, there's an imbalance. So that's essentially what we're doing here. And as you can see here, the market is an imbalance, like we just talked about. And the best call to action, which is the best response we have right down here, is essentially this is the environment to trade with conviction. You got to be very mindful, have fun, apply your strategy, and make money. So let me show you how that look on the chart. So here's a live trade setup we took in the live trading stream. We took this trade setup May 27th. And as you can see here, diagram of what a low resistance liquidity run environment looks like. And here's us taking advantage of that live. Here's our entry here. And as you can see, the first thing that stands out to you is clean price action. You see the high here being rated. You see fair value gaps being formed. You see strong expansion moves. Not a lot of like time pulling back. When it do pull back, right? When it do pull back, it don't stay down there for long. You see the order blocks being respected, as you can see here, right? And then another one would be here where this order block was actually created, and then you see an expansion move that happened here that's showing that price is truly bullish. So this is a beautiful trade setup, and the foundation of this trade setup comes from the fact that we are trading in a low resistance liquidity run environment. So this is how we trade. And as you can see, I closed out here, I clipped more profits here, and that was it, right? So nice clean trade setup. And this is literally what good healthy market condition looks like. And this is a bullish example. So the main takeaway for market environment is understanding that high resistance liquidity runs are bad market conditions. You should not be taking trades in these conditions. And if you notice that you are inside this condition, do not try to force a trade setup, because then you'll turn from one loss into 3 in a matter of time. And in low resistance liquidity run environments, these are optimal periods to trade in, because we make the most money in these periods. These periods are like the best because the market is moving and it's easy to read what's going on in the market. So this is why low resistance liquidity runs are very, very good and useful. That's it for today's lecture. I'll see you guys in the next. Please like, comment, and subscribe.